In 1720, the smartest man on earth, Sir Isaac Newton, made a financial decision so catastrophically bad, it cost him the modern equivalent of over $4 million. This wasn't a random mishap, it was a textbook case of falling victim to the very human flaw of fear of missing out, or FOMO. By the end of this video, you'll understand the full scope of Newton's financial disaster, precisely how his genius succumbed to market madness, and more importantly, you'll learn actionable strategies to protect your own investment portfolio from the same psychological traps that ensnared one of history's greatest minds. Sir Isaac Newton was far from a financial novice. As Master of the Royal Mint, he was responsible for England's currency, a position requiring shrewd financial acumen and meticulous attention to detail. By 1720, he was already a wealthy man, with a net worth estimated at over £32,000, a truly staggering sum for the era, roughly equivalent to several $1 million today. His initial involvement with the South Sea Company, a British trading firm granted a monopoly on trade with South America, actually began quite favorably. The South Sea Company, founded in 1711, was initially presented as a venture that would profit immensely from trading goods like slaves, sugar, and tobacco with Spain's colonies in South America. In reality, the company's primary function was to absorb a significant portion of Britain's national debt in exchange for lucrative interest payments from the government. It was an ambitious scheme, promising substantial returns, and Newton, like many other prominent figures, saw an opportunity. Newton first invested in South Sea Company stock early in 1720, buying shares when they were priced around £128. He held them for a few months, watched them climb to £200, and wisely decided to sell, netting a profit of £7,000 on his initial £2,000 investment. This was a fantastic return, a 350% gain in a matter of months. Most investors would celebrate such a success and move on, but the market was just getting started. The South Sea bubble was rapidly inflating. The company, through shrewd marketing and outright deception, painted a picture of unimaginable future wealth from its supposed trade monopoly. Rumors of vast gold and silver reserves in South America, accessible only through the company, fueled public excitement. The British government, eager to reduce its debt burden, actively supported the scheme, lending it an air of official endorsement and security. The price of South Sea Company stock began an astronomical ascent. From £128 in January, it surged to £330 in March, then £550 in May, and by June, it had soared past £800. By July, it peaked at an absurd £1,000 per share. This wasn't driven by any underlying business fundamentals. The company's actual trade with South America was minimal due to ongoing wars and Spanish resistance. This was pure speculation, a collective delusion that fortunes could be made overnight. But here's where Newton's story takes a tragic turn, illustrating the insidious power of FOMO. Having exited with a handsome profit, Newton watched from the sidelines as others continued to get fabulously rich. Friends, colleagues, even servants, who had held onto their shares or bought in later, were seeing their wealth multiply daily. The air was thick with stories of instant millionaires. Despite his intellectual brilliance and his earlier, prudent decision, Newton couldn't resist the allure of what he was missing. He succumbed to the collective madness. In June 1720, near the absolute peak of the bubble, Newton reinvested a colossal £20,000 into the South Sea Company. This was a sum so large it represented a significant portion of his total net worth. He bought back into the frenzy, driven not by logic or fundamentals, but by the overwhelming fear of being left out of what everyone else perceived as a guaranteed path to unimaginable riches. He was anchoring his decision to the recent sky-high prices, believing the trend would continue indefinitely. The inevitable crash came swiftly and brutally. By August, the price began to tumble, and by September, it had plummeted back to £150. By December, shares were trading at a mere £124, below where Newton had first invested. The entire edifice of speculation collapsed under its own weight, revealing the company's lack of real business activity. Thousands of investors, including Newton, were financially ruined. His personal loss from his second, ill-timed investment was an estimated £20,000, a devastating blow that he reportedly never fully recovered from emotionally. He famously declared, "I can calculate the motion of heavenly bodies, but not the madness of people." So, what specific lessons can we extract from this 300-year-old financial disaster that are directly applicable to your portfolio today? The core message is that human psychology, particularly our susceptibility to FOMO and herd mentality, remains unchanged. We see modern parallels constantly, from the dot-com bubble of the late 90s to the housing crisis of 2008, and even recent speculative frenzies around meme stocks or certain cryptocurrencies. Consider the recent phenomenon of chasing a single hot stock based on social media hype, ignoring its underlying financials. Many investors, fueled by stories of overnight millionaires, pour their savings into highly volatile assets, neglecting diversified portfolios. This is the exact same psychological trap that caught Newton. They are driven by the fear of missing out on quick gains, rather than the disciplined pursuit of long-term wealth building. Behavioral finance teaches us about biases like anchoring, where we rely too heavily on the first piece of information offered, like a stock's recent peak price, and confirmation bias, where we seek out information that confirms our existing beliefs while ignoring contradictory evidence. In the South Sea bubble, investors anchored to the idea of ever-rising prices and sought out stories of success, dismissing any warnings. Today, this manifests as ignoring PE ratios or debt levels in favor of a stock's trending chart. But understanding the why isn't enough. How do you actively protect your wealth from these timeless psychological pitfalls? First, embrace diversification. Instead of betting your life savings on a single speculative stock, invest in broad market index funds like an S&P 500 ETF. This spreads your risk across 500 of America's largest companies, providing exposure to market growth without the extreme volatility of individual stock speculation. This strategy has historically delivered consistent returns, far outperforming many attempts at stock picking. Second, cultivate a long-term perspective. Financial success is built through consistent, disciplined investing over decades, not weeks. Utilize tax-advantaged accounts like a 401k or Roth IRA, contributing regularly through dollar-cost averaging. This strategy automatically buys more shares when prices are low and fewer when prices are high, smoothing out your average purchase price and removing emotional decision-making from the equation. The IRS rules encourage this long-term approach with tax benefits for retirement savings. Third, always prioritize fundamental analysis over hype. Before investing in any company, understand its business model, revenue streams, profitability, and competitive landscape. Don't rely on anonymous online forums or social media trends. If you can't explain what the company does or how it makes money, it's likely a speculative bet, not an investment. This principle holds true whether you're evaluating a tech startup or a mature blue-chip company. Fourth, implement strict risk management. Never invest money you can't afford to lose. Set clear limits on how much of your portfolio you're willing to allocate to higher-risk assets. For instance, some financial advisors suggest a small percentage, perhaps 5 to 10%, for speculative plays, while the bulk of your portfolio remains in diversified, stable investments. Ensure you have a robust emergency fund, typically 3 to 6 months of living expenses, held in a high-yield savings account, HYSA, before you even consider investing in the stock market. This financial cushion prevents you from being forced to sell investments at a loss during market downturns. Finally, develop emotional discipline. Have an investment plan and stick to it, regardless of market fluctuations or the tempting stories of others' quick gains. A robust plan acts as a guardrail against impulsive decisions driven by FOMO or panic. This discipline is often a better predictor of long-term financial success than raw intelligence or market timing. Just as a good FICO score is built on consistent, responsible credit behavior, a strong financial portfolio is built on consistent, responsible investing. Isaac Newton, the man who codified the laws of gravity and calculus, ultimately lost millions not because he lacked intelligence, but because he succumbed to the irresistible siren song of market madness and the fear of missing out. His personal tragedy serves as a powerful, timeless reminder: true financial wisdom isn't about predicting the market's next move, but about understanding human nature and exercising unwavering discipline. To dive deeper into building a resilient portfolio that can withstand market madness, watch our video on the power of diversification, how to build a bulletproof investment strategy. Remember, your greatest asset in finance isn't your intellect, it's your emotional control.